Imagine this. You've got that brilliant idea, the one that, keeps you up at night, filling notebooks with scribbles and dreams.
Mm-hmm.
You see the solution, you know the problem it solves, and you're just ready to build the next big thing.
Yeah.
But then it hits you. How do you actually find the money to bring this vision to life? That thought alone can feel like scaling Mount Everest in flip-flops.
It really can. It's a completely different mountain to climb than, say, building the product itself or even leading a team. It's about translating that vision into a compelling financial opportunity.
You're absolutely right, and that's precisely the challenge we're tackling today with a deep dive into startup fundraising fundamentals.
Right.
And this isn't just a casual chat. Our session is actually built on a comprehensive workshop plan, really designed to demystify the entire fundraising journey for early-stage founders.
Our mission for this deep dive really is to extract the most important nuggets from this incredibly detailed source material. We want to give you a practical roadmap to understand the fundraising landscape, strategize effectively, master your pitch, approach investors with confidence.
And even get comfortable with the, let's face it, sometimes scary math of equity and dilution.
Exactly. That crucial math.
Think of it as your shortcut to being genuinely well-informed on what it really takes to get that first check.
Yeah.
By the end of this deep dive, you'll have a much clearer picture of what investors expect at different stages, how to craft a compelling story, navigate those tricky conversations, and grasp the financial mechanics that underpin it all.
Get ready for some serious aha moments, hopefully.
Definitely. So let's start at the very beginning. Who are these, mysterious investors, and where do they typically put their money at the early stages?
Okay, yeah. Good place to start. It fundamentally depends on the stage of your startup. So at the pre-seed stage, you're usually looking at individuals, maybe friends and family, individual angels.
Right, the angel investors.
Exactly. Or perhaps specialized pre-seed microfunds and sometimes incubators or accelerators. Their typical check sizes are, well, on the smaller side, usually ranging from maybe $25,000 up to $200,000. Though, obviously, this can vary a lot by market.
Okay.
They're betting heavily on the team at that point and just the raw potential of an idea.
So these are the folks who really believe in you and that early concept. What about when you've got a bit more momentum, say, at the seed stage? The game changes then, right?
The game definitely shifts.
Yeah.
At seed, the landscape expands quite a bit. You're typically engaging with angel syndicates.
So groups of angels investing together.
Precisely. Groups pooling their resources. Also, dedicated seed VC funds and sometimes larger institutional seed funds start to come into play. Their check sizes are significantly larger, generally falling maybe between $200,000 and, say, $2 million.
Wow, quite a jump.
It is, and they're looking for more concrete proof points by then.
That makes sense. Different stages, different players, different amounts. But what do these investors actually expect to see at each of those stages? What's the biggest difference in their criteria?
Well, their expectations evolve quite a bit, as you'd imagine. At pre-seed, investors are primarily looking for a strong founding team. People they can trust to execute, who demonstrate the grit and vision needed.
The team is everything early on.
Absolutely. They want to see a clear problem you're solving, a compelling solution, and critically, some early traction or even just a solid prototype. They also need a credible plan for how you'll eventually achieve product market fit. It's often more about potential and the ability to learn and adapt at this stage.
And once you're moving into seed, you mentioned proof points. What's the biggest mistake founders make trying to show demonstrable traction at this stage, and how can they avoid it?
Good question. By the seed stage, the bar is indeed higher. Investors want to see demonstrable traction, and I think the biggest mistake founders make here is presenting vanity metrics.
Ah, right, like total downloads versus active users.
Exactly. Don't just show total downloads. Show active users, show real revenue, or strong retention metrics. Stuff that shows people are actually using and valuing the product. They also scrutinize your unit economics.
Okay, could you just quickly define unit economics for us in case someone's not familiar?
Absolutely. So unit economics basically means proving that each individual user or customer generates more revenue over their lifetime than it costs you to acquire and serve them.
Making money on each customer, essentially.
That's the core idea. They want to see that fundamental profitability at the individual level, looking at metrics like customer lifetime value, LTV, customer acquisition cost, CAC, and the payback period. How long does it take to earn back what you spent to get that customer?
Got it.
And finally, at seed, a well-defined go-to-market plan is essential. They want to know you can not only build it, but also sell it efficiently.
Okay, it sounds like a lot to prepare for, and I imagine it's not exactly an overnight process.
Oh, far from it. Raising a round of funding, from your very first outreach to the money actually landing in your bank account, can take anywhere from, say, 3 to 6 months on average,
Mm,
sometimes longer.
3 to 6 months. Wow.
Yeah, that's why planning ahead is absolutely crucial. You really don't want to start fundraising when you're running on fumes.
Right.
And a big part of that planning is figuring out, well, exactly how much to ask for and why. Because more isn't always the right answer, is it?
And that's often a counterintuitive point for founders, isn't it? This idea that more money isn't always better. Why is that? What are the maybe hidden downsides of over-raising for an early stage startup?
Precisely. It feels counterintuitive, but the guiding principle is really to raise only as much as you need to reach the next meaningful de-risking milestone.
De-risking milestone. Okay.
Yeah, basically proving out a key assumption or hitting a major goal. This usually translates to about 12 to 18 months of runway, enough time to hit a key objective, like achieving product market fit, before you need to raise again.
And the downside of raising too much.
The hidden downside of raising too much too early is often excessive dilution. You end up giving away too much of your company before you've created significant value.
Hmm.
Plus, it can set really unrealistic expectations for your next round, making it harder to justify a higher valuation later.
Right, setting the bar too high for yourself.
Exactly. You're
Okay.
trying to unlock specific value-creating milestones with the capital, not just, accumulate cash.
So if you're aiming for that 12 to 18 months of runway, how do you even begin to budget for that effectively?
You need a detailed line-by-line budget for that 12, 18-month period. And I mean detailed, covering everything: payroll, marketing, product development, operations, legal expenses, all of it.
And buffers.
Absolutely. Don't forget to add us a 10–20% buffer for unexpected costs. Things always pop up, unexpected things happen, and you need that breathing room.
Good advice. And when's the optimal time to actually start this whole fundraising process? You mentioned not waiting until you're desperate.
That's right. The sweet spot, generally, is when you have at least 6 to 9 months of runway left in the bank. This gives you enough time to run a proper fundraising process without the pressure of an imminent cash crunch, which, believe me, investors can definitely sense. Desperation is not a good look in fundraising.
Noted. Okay, so once you know how much you need and when, the next step is figuring out who to talk to. How do you go about targeting the right investors, not just any investor?
Yeah, this is critical. Building an investor profile is key. Consider their sector focus. Do they invest in health tech like your company? So that's consumer. What's their typical ticket size, the stage they usually invest in, and their geographical preferences?
Hmm.
Do they only invest locally?
Right.
It's also vital to check their existing portfolio for any potential conflicts with your business. You don't want them invested in a direct competitor.
Makes sense.
And also see if they have a history of following on in later rounds. That's a very strong positive signal, shows they support their companies long term. You ideally want investors who can grow with you.
I've heard so much about warm intros being crucial, almost like a secret handshake in the VC world. Why are they so much more effective, and how do you actually leverage that?
Okay, yeah, warm intros. Why are they like 4 to 10 times more effective?
Yeah.
It's honestly more than just getting an email opened. It really comes down to trust transfer.
Trust transfer. Interesting.
Yeah, when a trusted contact, another founder they backed, maybe an LP in their fund, makes that introduction, they've essentially done half the vetting for the investor already. It immediately cuts through the noise and lowers the investor's perceived risk. It's like the ultimate social proof that you're someone worth talking to.
So how do you operationalize that?
You should categorize your target investors. Maybe tier 1 are your must-get investors, your dream list. Tier 2 are nice to get, and tier 3 are your backups.
Okay.
For each one, identify your preferred introduction sources. Really emphasize getting those warm introductions from your founder network, maybe limited partners of the fund if you can find them, or founders of companies they've already invested in. A personal intro is just gold.
So you've got this entire strategy mapped out: how much, when, who, how to reach them. Does this all kind of boil down to a concise, actionable document?
It absolutely should.
Yeah.
You need, ideally, a one-page strategy document that distills the core elements.
What's on that one pager?
Okay, you need
Yeah.
the amount you plan to raise and your rationale for it. Your desired investment instrument, or you thinking equity, a SAFE, a convertible note? We can talk more about those later.
Yeah, let's pin that.
Definitely. Your target valuation range, your timeline, your top 10 target investors, and a high-level breakdown of how you plan to use the funds. This document becomes your North Star, your internal rallying cry for the fundraising process.
All right, you've got your strategy. You know who to talk to. Now let's talk about the bedrock of any successful fundraising effort: the pitch deck. This isn't just a slideshow, right? It's your story.
Exactly. It's the narrative.
So what are the essential elements out of a winning, say, 10-slide seed deck? And how do you make each one really count?
Okay, the 10-slide structure is a good guideline. This is where you really tell your story in a structured way. First up, the cover or hook. And this isn't just a title slide. It's your one chance to make an investor stop scrolling through their inbox.
Gotta grab them quick.
You do. So it needs your company name, a crisp one-line mission, and crucially, if you have it, one killer traction metric right there on the front. Make them want to know more immediately.
Okay, so once you've hooked them, it's about building empathy, right? And what's the most effective way to do that in a pitch deck?
Next, you hit them with the problem slide. And this isn't just a point to tick off. It's where you aim to ignite empathy. Describe that customer pain point. Maybe use a really gut-wrenching quote from a customer or a vivid, concrete example.
Make it real.
Make it real. And crucially, quantify it if you can. How many people are trapped by this problem? What's the crushing cost in time or money? Make the scale of the problem clear.
And then, naturally, the magic solution to that pain.
That's your solution slide. A short, powerful description of your product and exactly how it directly fixes that problem you just outlined. This is where visuals like screenshots or even a short demo GIF can really shine. Make your product tangible and immediate.
Next, the market. Investors always want to know about market size TAM, SAM, SOM. How do you avoid sounding overly optimistic here, like you're just throwing out huge numbers?
Yeah, that's a common pitfall. The market size slide needs to cover TAM, total addressable market, SAM, serviceable available market, and SOM, serviceable obtainable market, your realistic initial target.
Yeah.
The key is to show both top-down analysis, starting big, and bottom-up analysis, building from specifics. Be conservative in your estimates, don't overreach, and always cite your sources. Credibility is paramount here.
Then a quick look under the hood with product and tech. What should founders focus on here to avoid getting too bogged down in technical jargon?
Right. On the product tech slide, you'll want to show your high-level architecture. The goal isn't to detail every line of code, but to demonstrate your technical foundation is solid. Crucially, though, emphasize your defensibility.
Defensibility? What do you mean?
What makes it hard for others to copy you? Think intellectual property, IP, unique data moats you're building, network effects that get stronger with more users. Why is your secret sauce so hard for a competitor to replicate? That's what investors want to see.
And then, the moment of truth. How you actually plan to make money.
That's the business model slide. Explain how money is made, subscriptions, transactions, ads. Detail your pricing strategy. And this is a great place to reiterate your strong unit economics. Remind them about LTV, CI, and that payback period. Show them it's a potentially profitable engine.
Then the proof. The actual numbers that show you're onto something.
Absolutely. The traction and KPI slide is vital, especially at the seed stage. This is where you prove your hypothesis with real data. Show growth curves, users, revenue. Show retention rates. Highlight other key metrics using real, verifiable numbers. Don't just say you're growing. Show the hockey stick or whatever positive trend you have.
Now, no startup exists in a vacuum. There's always competition. What's the best way to address the competitive landscape and really stand out?
That's the competition and differentiation slide. And please, don't just list competitors. Present a competitive map, maybe a 2x2 grid, showing where you sit versus others on key dimensions, and then articulate clearly why you will win.
So acknowledge them, but focus on your edge.
Exactly. It's not about pretending competitors don't exist. It's about showing your unique advantage, your secret weapon, your unfair edge that will allow you to capture market share despite them.
Then how you'll actually reach those customers and scale up.
That's your go-to-market plan slide. Detail your primary channels. How will you acquire customers? What's your sales cycle look like? Are there strategic partnerships you're leveraging? And how do you plan to scale these efforts? Investors need to see a clear path to getting your solution into the hands of many more customers.
And finally, wrapping it up with the all-important team and the ask itself.
The team and ask slide. Crucial finish. Include concise founder bios, just 2 to 3 key highlights each. List any key advisors if they're significant. You want to highlight relevant experience or unique insights that make your team the absolute right one to solve this problem.
And the ask.
Be precise. State your exact ask. The amount you're raising, $500K, $1, whatever it is, the proposed valuation or the instrument you're using, like a safe with a cap, and a high-level breakdown of how you'll use those funds, key hires, product milestones, market expansion. Yeah. Be confident and clear.
Those are the mechanics, the essential slides. But how do you weave it all together? How do you make it truly captivating? Storytelling is so important, especially when investors are seeing dozens, maybe hundreds of decks.
It really is. You have to make it more than just slides. Start with that customer story to build immediate empathy like we talked about with the problem slide. Use the why now argument effectively.
Why now?
Explain why this is the perfect moment for your solution. What's changed in the market, in technology, and consumer behavior that makes your timing impeccable. Create urgency. And remember the basics. Keep each slide focused on a single big idea. Avoid dense text or bullet point overload. Make it a narrative, not a data dump.
And on the delivery and design side, what makes a pitch visually compelling and easy to absorb, especially if an investor is just quickly reading through it initially?
Good point. Clean visuals, large fonts, seriously, make them bigger than you think, and a consistent color palette are essential for readability. Use charts over tables whenever possible. They're much easier for the brain to quickly grasp a trend or comparison. And critically, for your preparation, include speaker notes for each slide with the 2-3 key sentences you absolutely want to deliver. This keeps you focused during the actual pitch without forcing you to read directly from the slide, allowing for a much more natural conversational delivery.
That's super practical. Now, to bring all this theory to life, let's dig into that real-world example you mentioned, the Nutranet case study. You said this health tech startup applied these very principles with impressive results.
Yes, Nutranet is a great illustration. It was founded back in 2023 by 2 nutritionists and a software engineer. Their mission, pretty compelling, was to help people manage diet-related diseases like diabetes and hypertension using AI-powered personalized meal plans. They really spotted a huge underserved need in the market.
Okay, and at the time they decided to fundraise, what stage were they at? What did they have?
They were definitely pre-seed. They had an MVP, a minimum viable product, ready. They had about 500 beta users providing feedback. And crucially, they have started generating some early revenue, around $5,000 in monthly recurring revenue, or MRR. So early, but with some validation.
Okay, 500 users, 5K MRR. What was their specific goal for this funding round? What did they need the money for?
Their goal was very clear and focused, raise $500,000. And they knew exactly why. This capital was specifically earmarked to enhance their AI recommendation engine, make the core tech better, strategically launch in 2 new cities to prove scalability and make key hires, a marketing lead, and 2 more software engineers to really accelerate growth.
Seems well thought out. And how did they strategize their fundraising approach? Given that goal, who did they target?
They were meticulous about it. They built a target list of 30 angel investors and 5 micro VCs, all specializing in health tech or related areas. They set a focused 6-month timeline to close the round, which is, ambitious but definitely achievable with good planning.
And the terms?
They decided to offer 15% equity in the company, which implied a $3.3 million post-money valuation based on their $500 K raise. They clearly knew their numbers and what they were willing to offer.
What were some highlights from their actual pitch deck that really resonated with investors? What made them stand out from the crowd?
Several things stood out. Their problem statement was framed powerfully and resonated immediately. 1 in 3 adults suffer from diet-related diseases. That's a huge, relatable problem.
Yeah, hits home.
Their solution was concise and compelling. AI-driven meal plans with integrated grocery delivery. It clearly addressed the pain point and offered a tangible, convenient fix. For traction, they didn't just say, "We have users." They presented real, verified numbers. Those 500 beta users, a strong 70% retention rate, which is key, and important early partnerships with 3 local clinics, adding credibility.
And the market.
They clearly identified their target market, a massive $40 billion health tech nutrition segment just within the Mini-Air region. This showed investors both a deep understanding of their space and, obviously, huge future potential.
So with all that preparation, the strategy, the clear ask, the compelling pitch, what was the final outcome for Nutranet?
They successfully raised $520,000, actually slightly exceeding their initial target. The funding came from 4 angel investors and one of the micro VCs they targeted.
That's fantastic.
It was. And the feedback was that investors were particularly impressed by their solid early traction. The clear expertise of the founders in both nutrition and tech, that domain knowledge really mattered, and the clear articulation of that large, addressable market size.
And what happened after they got the funding?
They executed. Post-funding, they immediately expanded into the 2 new cities as planned and, impressively, doubled their user base in just 8 months. It's really a great example of these principles in action, proving that rigorous preparation truly pays off.
Great story. Okay, so once you've honed your story and your deck, it's time to actually engage with investors. We've touched on it, but let's just reinforce it. The undeniable power of warm intros versus cold outreach.
Yeah, it bears repeating. There's simply no contest, really. Warm introductions via mutual contacts are, as we said, something like 4 to 10 times more effective than just sending a cold email out of the blue.
Why is that gap so huge?
It's that trust transfer again. That's why actively building your network, going to relevant events, participating in accelerators, genuinely connecting with other founders and people in the ecosystem is so invaluable. It's all about getting that crucial initial validation from someone the investor already knows and trusts.
But okay, let's be real. Sometimes you have to do cold outreach. Maybe you don't have a connection to a specific fund you admire. What's the blueprint for a cold email that actually gets noticed in an investor's incredibly crowded inbox?
All right, if you must go cold, keep it extremely concise, almost brutally so. Use a short, punchy subject line, maybe something like referral, your company name, mutual contact name, if pos, or just a very direct value prop.
Get straight to the point.
Absolutely. Your opening hook should be just 1 to 2 sentences max. Dedicate one single line to why you're specifically reaching out to this particular investor show you've actually done your research. That this isn't just a generic blast.
Personalization is key.
Critical. Include one sentence on your key traction metric, your single biggest proof point, and finish with a very clear, low-friction call to action, like suggesting a brief 20-minute introductory call. Less is definitely more here. Respect their time intensely.
Before you even get to that full meeting, there's that crucial 2-minute intro or elevator pitch. We all hear about it. How should that be structured to captivate someone immediately, whether you're literally in an elevator or just at a quick networking event?
It's a tight, disciplined sequence you need to practice. Start with the problem for about 20 seconds. Make it tangible, make it urgent. Then quickly move to your solution for around 40 seconds. How are you solving that problem?
Okay, problem solution.
Follow that with your traction for about 30 seconds. Show what you've achieved so far, the proof. And finally, end with your ask for the last 20 seconds or so. What are you looking for next?
Problem solution, traction, ask, 2 minutes.
Exactly. This concise structure forces you to be incredibly clear, impactful, and hopefully leave them wanting to know more right from the very beginning.
Now, for the main event, the actual investor meeting. Let's say it's a typical 30 to 45-minute session. How should a founder navigate that interaction to maximize their chances of getting a follow-up meeting?
Good question. Structure helps. The first 0-3 minutes are for pleasantries, building a little rapport, and clearly restating the goal for the meeting. Thanks for your time. Excited to tell you about X and explore if there's a fit.
Set the stage.
Precisely. Then, for maybe 3-10 minutes, deliver that polished 2-minute pitch, perhaps quickly walking through the core slides for context. But the bulk of the meeting, say from 10-30 minutes, should be dedicated to Q&A.
This is where the real interaction happens.
This is where you shine. Be honest. Present your metrics clearly and confidently, and crucially, don't shy away from admitting open risks or challenges. But always pair that with your concrete plan to mitigate them. This builds immense trust.
So address risks proactively.
Absolutely. It shows you've thought things through. Finally, use the last 5 minutes or so to confirm the next steps and a potential timeline. And don't be afraid to actively ask for feedback right then and there, and explicitly ask for the next meeting if you feel it went well.
Okay, and after the meeting, what's the right follow-up cadence look like? You don't want to be annoying, but you also don't want to just disappear into the ether.
It's definitely a balance. Send an immediate thank you email, ideally within 24 hours, maybe 48 max. Share any materials they requested during the meeting.
Prompt follow-up.
Very important. Then follow up again in about a week, maybe with a brief update, any new traction, a quick answer to a question that came up, just a light touch point. If there seemed to be strong interest, a final check-in around 2 weeks after that initial meeting might be appropriate.
If you hear nothing.
Look, if there's no response after maybe 3 polite, value-adding attempts, not just checking in, it's probably time to respectfully move on. Keep a record, maybe try again in 6 months if things change significantly. But your time is valuable too. Focus your energy where there's engagement.
That's practical advice. Okay, so let's shift gears a bit. We've talked about getting the meeting, making the pitch, potentially getting a yes. But what does this all mean for a founder's ownership in their company? Let's try and decode the world of equity, cap tables, and the often feared topic of dilution.
Right. The numbers side. It's crucial.
First, just to ensure we're all on the same page, when we talk about a cap table, what are we really looking at? What is that thing?
Yeah, okay, so when we talk about a cap table or capitalization table, we're essentially looking at a spreadsheet, basically, that acts as a snapshot of who owns what in your company. It's a comprehensive record of all the equity.
Who owns the pieces of the pie?
Exactly. Who has how many shares, what percentage that represents, whether it's the founders, employees through an option pool, or all your various investors from different rounds. It's literally the definitive record of ownership.
Got it. And then there's pre-money and post-money valuation. These terms get thrown around constantly, always sound a bit abstract, but they're absolutely critical to understand, aren't they?
They are, and they're actually pretty simple once you break them down. Pre-money valuation is simply the agreed-upon value of your company before any new investment cash comes in.
Okay, value before the money.
Right. And post-money valuation is just your pre-money valuation plus the new investment amount. So it's the total theoretical value of the company immediately after the money has landed and the new shares have been issued.
Pre-money plus investment. Post-money. Simple enough.
Exactly.
So if an investor puts in a certain amount of cash, how do we calculate their actual ownership percentage in this newly valued company using those terms?
Their ownership percentage is calculated pretty easily.
Right.
You just take their investment amount and divide it by the post-money valuation of your company.
Investment divided by post-money.
That's it. It's straightforward math, but obviously super crucial to get right,
Yeah.
as it determines how much of the company they own and how much everyone else owns afterwards.
Okay, let's do the math then. Can you give us a simple numeric example so we can really see it in action, make it concrete?
Sure. Okay, let's say your company has an agreed pre-money valuation of $2 million,
Ah.
and you're looking to raise $500,000 in this round.
Okay, 2 million pre 500K raise.
Right. So your post-money valuation would be that $2 million plus the $500,000 investment, which equals $2.5 million.
Makes sense.
Now, to find the investor's percentage, you take their investment, $500,000, and divide it by the post-money valuation, $2.5 million. So 500K, 2.5 M&M equals 0.2.
Which is 20%.
Exactly, 20%. This means the founders, assuming they owned 100% before this investment, would collectively retain the remaining 80% of the company immediately after this round closes.
That's clear for the percentages. Now, let's get into the maybe slightly trickier part. The nitty-gritty of shares and how new shares are actually issued. Because this is where dilution really starts to sink in for founders, seeing the share counts change. Let's imagine a starting point, say 10 million initial shares held by founders and maybe an employee option pool.
Okay, good starting point. Let's say founder A has 8 million shares, maybe representing 80% ownership initially. Founder B has 1 million shares, or 10%. And there's an employee option pool set aside with 1 million shares, also 10%. So that's our total of 10 million shares outstanding before the investment.
Right, 10 million shares total. Now, using our previous example, the investor is going to receive 20% post-money. How do we figure out how many new shares need to be issued to that investor to get them to 20%?
Right. So we know the existing shares, let's call that initial, is 10 mils in. We need to calculate the number of new shares for the investor, let's call that SNU. The formula is that the investor shares divided by the total shares must equal their ownership percentage. So SNU, initial plus SNU, needs to equal 0.20 or 20%.
Okay, so we solve for SNU.
Exactly. If you rearrange that equation and solve for SNU, it comes out to be 2,500,000 new shares. So the company issues 2.5 million brand new shares specifically to that investor for their $500.
Okay, so the total number of shares outstanding actually changes now, which is what affects everyone's piece of the pie, their percentage.
Precisely. The new total shares outstanding become the original 10 million existing shares, plus these 2,500,000 new shares, giving us a new total of 12,500,000 shares.
And how does that break down percentage-wise now?
Let's look. Founder A still has their 8,000 shares, but now that represents 64% of the new 12.5 M total. 8 million, 12.5 M, 0.64. Founder B's 1,000 shares are now 8%, 1 M totaling 12.5 M. The option pool's 1 million shares are also 8%. And the investor's 2,500,000 new shares correctly represent 20%. 2.5 M, 12.5 M.
Wow, okay, you can really see the dilution effect there. The founders' original percentages dropped significantly even though their number of shares didn't change.
That's dilution in action. Your number of shares stays the same, but the total number of shares increases, so your percentage ownership decreases. Yeah.
And it doesn't stop there, does it? Because most successful companies raise multiple rounds of funding. How does this dilution effect play out across subsequent rounds, say, from this seed round to a Series A?
It definitely compounds. It's
Right.
something founders need to understand from day one. Let's continue with our example. After this seed round, Founder A's ownership is now down to 64%. Now let's imagine a successful Series A round happens later. Let's say the pre-money valuation for Series A is $15 million, and the company raises $5 million in new capital.
Okay, 15M pre $5 Mara raise for Series A.
Right. So the post-money valuation for the Series A round is now $15 million plus $5 million, which equals $20 million.
Got it. So the Series A investors' percentage in this round is...
Simple calculation again. $5 million investment divided by the $20 million post-money valuation. That equals 0.25 or 25%.
Okay, 25% for the new Series A investor.
Correct, which means the existing shareholders, including our Founder A, Founder B, the option pool, and the seed investor, now collectively own the remaining 75% of the company after this new Series A investment.
So to find Founder A's new ownership percentage after this second dilution event,
You take their current ownership percentage, which was 64% after the seed round, and you multiply it by that remaining fraction that the existing shareholders own, which is 75% or 0.75.
right, and the math there is 0.64 times 0.75, which equals, let me see it, 0.48.
Exactly, 48%. So Founder A's ownership has now gone from 100% initially down to 64% after the seed round, and now down to 48% after the Series A round. This clearly demonstrates how ownership percentages continue to change and decrease with each new funding round.
It really highlights how important valuation and the amount raised are at each stage. Each round slices the pie differently.
Precisely. Your stake gets proportionally smaller each time new money comes in, unless you also participate, even if, hopefully, the total value of the pie is growing much, much larger, making your smaller slice still worth more.
That makes sense. Now, beyond these straight equity rounds where you sell shares directly, there are other common instruments used, especially in early-stage fundraising. Can you quickly explain safes and convertible notes? They seem really popular for their simplicity, right?
Yeah, they are very common, especially early on. So an equity round, as we've been discussing, is the most straightforward. A direct sale of shares at a negotiated price and valuation right now.
Okay.
A SAFE, which stands for Simple Agreement for Future Equity, is basically an agreement, not debt, that promises the investor equity in the future, specifically when the company raises its next price round, like a Series A.
So it converts later.
Exactly. It converts into equity then. It's popular because it's generally simpler and faster legal paperwork than a full equity round. But importantly, it often includes terms favorable to the early investor, like a valuation cap.
What's a valuation?
Good question. A valuation cap sets a maximum valuation at which the SAFE will convert into equity in that future round, even if the actual round is priced higher. It protects the early SAFE investors' upside. They might also get a discount on the price per share compared to the new investors.
Ah, okay. So they get a better deal for coming in early.
That's the idea. Now, a convertible note is slightly different. It is technically structured as debt initially. It accrues interest, has a maturity date, but the intention is usually for it to convert into equity at the next priced round, similar to a SAFE.
So it's debt that becomes equity.
Essentially, yes.
Okay.
And like SAFEs, convertible notes also typically include conversion discounts and valuation caps to reward the early investor. They were more common before SAFEs came along, but you still see them. Both are popular mainly because they allow the company and investors to defer the difficult conversation about precise valuation until a later stage when there's more data.
That makes a lot of sense for very early stages. Any final practical tips for founders managing this complex world of equity, especially thinking about future growth and attracting new talent?
Yes, a couple of key things. First, try to establish or increase your employee option pool before you set the pre-money valuation for a new funding round. Investors often expect or even demand that the option pool be refreshed, and they usually want it calculated on a post-money basis, meaning it dilutes everyone, including them, proportionally. Getting it sorted beforehand simplifies negotiations.
Good tip. Handle the option pool first.
Second, when you're negotiating your cap table structure, always think about future hires and future funding rounds. You absolutely need to leave enough room in that option pool, typically aiming for at least 10–20% unallocated initially, to attract and retain key talent as you grow. Don't give it all away too early.
Plan ahead for future dilution and hiring needs.
Exactly. And finally, perhaps most importantly, keep your cap table meticulously updated, religiously. After every new hire grant, every investor transaction, use cap table software if you can. It's your company's financial DNA, and inaccuracies can cause major headaches down the line, especially during due diligence for future rounds or an acquisition.
Keep it clean, keep it current. Got it. Wow. We have covered a ton of ground today, from mapping out the strategy to crafting the pitch. understanding the investors, and now demystifying the complex numbers around equity and dilution.
It's a lot, for sure. Fundraising is a beast.
It really is. To maybe synthesize all this for success, as founders are getting ready to embark on this journey, what are the absolute core reinforcements or key takeaways you'd want them to really internalize?
Okay, if I had to boil it down, maybe 4 key things. First, remember that investors fundamentally invest in teams, not just ideas. While your amazing idea gets you in the door, investors truly bet on you and your team.
It's about the people.
It's absolutely about the people. It's not just about your collective resume. It's about demonstrating your resilience under pressure, showing you're coachable, and making them believe they can imagine building alongside you for the next 5–10 years. They're looking for long-term partners, not just employees for their capital.
That's a powerful perspective. What's second?
Second, money is a tool to hit specific milestones. Don't just raise as much as you possibly can. Raise enough to reach those next crucial milestones, plus that buffer we talked about. Be strategic about the capital.
Purposeful fundraising. Got it. Third.
Third, practice your 2-minute pitch until it sounds completely natural and polished. Investors can absolutely tell the difference between someone reading a script or stumbling through versus someone who deeply understands their business and can articulate it effortlessly. That confidence matters.
Practice, practice, practice. And fourth,
And finally, number 4, be transparent about your risks. Don't try to hide them, but always show your concrete mitigation plan. How are you thinking about tackling those challenges? This builds immense trust and shows you've really thought things through, warts and all.
that's great advice. What if you do all that and you still face objections from investors during the meeting? Say they push back hard on your valuation, or they seem really concerned about the competition. How do you handle those tricky moments gracefully without getting defensive?
Yeah, objections are normal, even expected. If an investor pushes back on your valuation, first, don't get defensive. Be prepared to calmly explain your assumptions, highlight the milestones you've already hit that justify it, and perhaps show comparable valuations for similar companies in your space or stage.
Use data to back it up.
Exactly. You should also show you're flexible and open to discussion. Maybe suggest alternative structures, like using a safe with a valuation cap instead of pricing the round immediately, as a way to bridge the gap if valuation is the main sticking point.
Show you're willing to find a solution.
Right. If they bring up competition, again, don't dismiss it. Acknowledge the competitors they mention. It shows, your landscape. But then immediately pivot to clearly articulating your defensible differentiators. What makes you unique? Is it your team's specific expertise, proprietary data, a technological edge, key strategic partnerships? Don't just ignore competitors. Explain convincingly why you are positioned to win despite them.
Acknowledge and differentiate. Okay. And any quick negotiation tips for those really early rounds, maybe seed stage, especially regarding specific terms in the term sheet that can really impact a founder down the line?
Yeah, a couple things come to mind for seed stage. First, be cautious about giving away board seats too lightly. While investor input is valuable, you generally want to maintain control over day-to-day operations and keep the decision-making process lean and fast early on. Maybe offer observer rights instead of a full voting seat initially.
Protect board control early. Makes sense.
Second, really understand the basics of liquidation preferences. A 1x non-participating preference is generally considered the most startup-friendly standard.
Okay, what does 1x non-participating mean in simple terms?
Basically, it means that if the company is sold, the investors get their initial investment back first, that's the 1x, but then they don't also get to take their ownership percentage slice of the remaining proceeds alongside the founders and employees. That's the non-participating part. They choose one or the other.
Ah, so they don't get to double dip.
Exactly. It prevents investors from potentially getting both their money back and their pro rata share in certain scenarios, which can significantly eat into the founders' and employees' returns, especially in less than stellar exit outcomes. So, aiming for 1x non-participating is usually a good goal for founders in early rounds.
That's a really important detail. Wow, what an incredible deep dive into the fundamentals of startup fundraising. It's truly a comprehensive journey, isn't it? From the initial strategy to crafting that compelling pitch, navigating investor meetings, and then understanding the intricate, crucial numbers of your cap table and dilution.
It really covers a lot of ground.
It's clear this is a marathon, not a sprint. And as we've explored today, knowledge truly is power in this journey. The more you understand, the better you can navigate it.
Absolutely. And the more prepared you are, the better positioned you'll be to attract not just any capital, but the right kind of capital, the right kind of strategic partnership.
That's a perfect segue to a final thought. You've learned from this deep dive how to prepare for and execute a fundraising round. But beyond just getting the money, what truly makes an investor the right investor for you?
Hmm. That's the deeper question.
Right. Consider that fundraising isn't just about capital, it really is about forging a strategic partnership, often for many years. So, the provocative thought for you, the listener, is what kind of long term relationship and support are you, as a founder, truly seeking beyond the check? And how might that deeper need influence your approach to finding and selecting investors? Because ultimately, it's not just about who will write the check, but who will truly help you build for the future, becoming the right kind of ally to have by your side for the long haul.